right, welcome to Iron Financial. We're the only place you're going to find that helps you forge a stronger portfolio by cutting right through all the market weakness. I'm your lead analyst, and with me, as always, our Market Skeptic is here to keep things grounded. Today, we are putting Dollar Tree directly under the forge, right on the anvil. The company just dropped its latest earnings report after making a massive strategic move. They sold off the entire struggling Family Dollar business. And now, well, the market is completely split. No one knows what to think. Are we looking at a rebuilt fortress, reinforced with solid steel, or is this just a nice-looking facade that's going to get blown over by the first strong wind? We're here to run the numbers, to stress test the foundation, and to deliver the iron verdict. Let's get to work. So, the main question for every single investor staring at this stock right now seems simple, but believe me, the answer is buried deep. Now that Dollar Tree has basically performed major surgery on itself, cutting out the entire Family Dollar business, what are we left with? Are we looking at a leaner, more focused, more profitable machine that is just coiled and ready to rip higher? Or did that surgery just expose some deeper, more fundamental problems that were hiding in plain sight? Today, we are going to put this brand new corporate structure through a serious financial stress test. We are going to find the answer. Look, the market hates uncertainty, but for us, that's exactly where we find opportunity. And here's how we're going to do it. This is our roadmap, the exact blueprint we use to figure out if a company's structure is actually sound. First up, we're going to look at the new blueprint, so we can all understand what this company even is anymore. Then, I'm going to walk you through the bull case, what we're calling forging a stronger core. After that, our market skeptic is going to jump in and point out all the cracks in the foundation. That's the bear case that has the other half of Wall Street running scared. Then, it's time for the main event. The stress test. This is where we slam the bull and bear arguments right into each other, head to head. And finally, we deliver the iron verdict. Okay, let's get right into it. To make any sense of the numbers we're about to throw at you, you first have to really wrap your head around the massive structural shift that just happened here. I'm serious. Dollar Tree is not the same company it was last year. It's not even close. They've fundamentally torn up their old blueprint by selling off the entire Family Dollar segment. This wasn't just some small adjustment. It was a tectonic shift, something that's been in the works for years, and it changes everything about how we look at every single metric from here on out. We have to be absolutely crystal clear about what we're analyzing, because the old story, it's totally irrelevant now. Now, you're going to see this term all over the reports, and you cannot, I repeat, cannot gloss over it. Continuing operations. This isn't just some boring accounting term. It is the entire investment thesis boiled down to two words. Continuing operations is the pure, focused, core Dollar Tree business that management is betting the entire future of the company on. All the noise, all the operational headaches, all the brand damage that came from those underperforming Family Dollar stores, gone. Surgically removed. So when we analyze the health of this company from now on, this is the business we're talking about. It's the only thing that matters. So here's the bottom line. Management made a huge bet the company kind of decision. The sale of Family Dollar, which was finalized back in July, wasn't just about getting a nice check. It was about strategic focus. They basically cut off a diseased limb to save the patient. The whole idea here is that by getting rid of the dead weight of a complicated, underperforming business, they can now pour every ounce of their capital, their brainpower, and their strategic energy into making the core Dollar Tree brand an absolute fortress in the discount retail space. It's a leaner, meaner, more focused machine now. The question is that machine actually built to last? Let's find out. All right, let's get to the good stuff, the numbers. It's time to build the bull case. If you're an optimist on Dollar Tree, if you actually believe in this new strategy, then you're looking at their latest report and you're seeing the clear outline of a really powerful, well-built structure. The headline numbers look really strong. And I don't just mean good. They're showing real signs of momentum. And, most importantly, expanding profits, now that they're not being dragged down by their weaker half. Let's lay down the first pillar of this brand new foundation. First off, just look at the sheer size of this thing. Even after selling off a huge piece of their business, the core Dollar Tree still cranked out $19.4 billion in net sales for the fiscal year. Now, let me put that into perspective for you. That is more than the entire GDP of countries like Iceland or Jamaica. What this tells you is that the business that's left over isn't some tiny little niche player. No, it is a dominant, powerful force in American retail with incredible reach. This is not a company that's fighting to survive. It's a giant that's just refocusing its immense strength. And you know what? That strength is growing. And this right here, this shows you the momentum I'm talking about. In the most recent quarter, which is always the most important one, net sales from these continuing operations shot up a full 9% compared to last year. Look, in this economy, where you've got major retailers fighting tooth and nail just to stay flat, a 9% top-line growth for a company this big is incredibly strong. This isn't just a number, it's a signal. It tells you the core brand isn't just stable, it's actually accelerating. Customers are responding to what they're doing, and that's translating directly into cash in the register. This is the sign of a very, very healthy engine. But hey, sales are just one part of the equation, right? A strong building has to be profitable. And right here, Dollar Tree delivered in a huge way. Fourth quarter adjusted earnings per share came in at $2.56. And what's really important is that this number easily beat what Wall Street analysts were expecting. Now, beating the street isn't just about a nice headline for the day traders. It's a signal of rock-solid operational discipline. It means management is keeping a tight lid on costs, they're pricing things right, and they're turning that strong sales growth into real hard profit for shareholders. That is the sign of a well-oiled machine firing on all cylinders. Okay, let's drill down into the official results and see how this all stacks up. Just look at this table. We already hit on that impressive 9% sales growth, but check out that second line, same-store sales. For anyone who doesn't know this metric, we call it comps, it only looks at sales from stores that have been open for at least a year. It's the purest way to measure a retailer's real health because it cuts out the noise from new store openings. A 5% comp is very, very good. But the real story here, the load-bearing pillar of this entire bull case, is that operating income line. Up 30.2% year over year, that is a massive, explosive number. It tells you that the profitability of every dollar they bring in is just skyrocketing. They're not just selling more stuff, they're making way more profit on everything they sell. This is what a well-built profit engine looks like. So, how in the world did they pull off that massive jump in operating income? This slide shows you the gears of the machine. First, gross margin expanded by 150 basis points. That's a huge move, and it was driven by smart pricing and, critically, lower shipping costs, which shows they've got a good handle on the supply chain. Second, just look at the cash. This business is a cash machine. It spun off $1.1 billion in pure free cash flow for the year. And what are they doing with it? They're not just letting it pile up. They pumped nearly $1.6 billion back to shareholders through stock buybacks. That reduces the number of shares out there and boosts earnings per share. This is a sign of extreme confidence from management. Strong margins, huge cash flow, and aggressive returns to shareholders. These are the pillars of a rock-solid company. The bull case looks like it's built out of granite. Whoa, hold on a second. That's a real pretty picture you painted, if you only look in the rearview mirror. A solid foundation isn't judged by how it stood up yesterday. It's judged by whether it can handle the storms that are coming tomorrow. And when you stop admiring the pretty numbers from the past, and you start looking at the company's own forecast for the future, you start to see some deep, serious cracks forming in that granite foundation. Remember, the market is always looking ahead, and the future, according to Dollar Tree itself, looks incredibly shaky. And hey, don't just take my word for it. This headline from Fine Day Radio perfectly sums up the entire bear case. Dollar Tree projects weak sales as cash-strapped shoppers cut back, right? After all that talk about amazing past growth, it's the company itself that's telling the market to get ready for a big slowdown. This isn't me making things up, and it's not some analyst's wild guess. This is coming straight from the top, from the C-suite. So the billion-dollar question is, why are they suddenly so worried if the business is supposedly so strong? Let's put some real numbers to that worry. This slide is so important. It compares what Dollar Tree's own management team thinks they'll make in revenue next year against what Wall Street analysts were expecting. Management says somewhere between 20.5 and 20.7 billion. The analyst consensus, basically the collected wisdom of the market, was at the very top of that range, 20.69 billion. That means the middle of the company's own forecast is below what the street was hoping for. Listen, when a company is less confident than the outside analysts covering them, that is a huge red flag. It tells you they are seeing weakness inside their own four walls that the market hasn't totally picked up on yet. And here it is. This is the biggest, ugliest crack in the whole foundation. Let's really dig into how they got that 5% same-store sales growth you were so proud of. This chart breaks it all down. The average ticket, how much each customer spent when they came in, was up a strong 6.3%. Fine, that's them raising prices. But look at the other bar. Customer traffic was down 1.2%. Let me be absolutely clear about what this means. They are not getting more customers. In fact, they are losing them. They are making up for having fewer people in their stores by charging the loyal customers who are left more and more money. This is not a sustainable way to grow. You can only raise prices so much before your dwindling customer base finally gives up and walks away for good. This doesn't look like a strong foundation. It looks like they're trying to patch gaping holes with expensive wallpaper. And, this isn't happening in a bubble. Let's zoom out and look at the economic world this supposedly strong building has to exist in. The February unemployment rate just ticked up to 4.4%. You see consumer prices rising everywhere. And it's not just Dollar Tree. Their biggest competitor, Dollar General, also just put out a weak forecast, and they're blaming the exact same problems. The very ground underneath their stores is shifting. The core customer for these places, the lower-income consumer, is getting squeezed from every direction. Like the company itself said, these price-conscious customers become more choosy. A weak forecast isn't just a company problem. It's a sign that their entire customer base is flat out running out of money. And that is a deep structural problem that no amount of fancy accounting or margin expansion is going to fix. Okay, so we have two stories that are in complete opposition to each other. On my side, we have a set of incredibly strong results from the past for this newly focused company. And on the other side, we have a weak forecast for the future and some really troubling signs about the health of their customers. You can't just ignore one side. So now it's time to run the stress test. We're going to put these two cases head to head, point by point, to figure out the true structural integrity of Dollar Tree right now. This is where we separate the solid steel from the crumbling concrete. Okay, let's use this table to frame it up. The bull case is simple. You cannot ignore a 5% comp sales number in Q4. That's real strength in a tough market, period. But is it real strength? Their own guidance for the full year is only 3 to 4%. They're telling you themselves that 5% isn't going to happen again. They are forecasting a slowdown. That Q4 number is already ancient history. Okay, fine. But look at the margin expansion, 150 basis points. That's pure operational skill. That's not a guess. It's a fact on the income statement. It's real profit. But who cares about profit margins if your customer base is literally shrinking? That negative 1.2% traffic number is the most important number on this entire page. It tells you that the core demand for what they sell is getting weaker. You can't have margins on sales you don't make. And that is exactly why they're buying back so much stock, over $1.5 billion. They're so confident in their future cash flow that they're putting a ton of capital to work for shareholders. Or they're trying to fake a higher earnings per share number with financial tricks because they know that real organic growth from new customers is drying up. It's a classic move when growth slows down. Look at the macro pressure out there. It's a hurricane, but they just rebuilt the house for this hurricane. The clean structure after the sale, it makes them leaner and stronger to weather this exact kind of storm. They're better prepared than ever. Oh, really? Then tell me this. If they're so strong and so confident, why is their official forecast below what even the most optimistic analysts were hoping for? It just doesn't add up. And you know what? Clearly, we are not the only ones having this exact same argument. This is not a simple story. Just look at how Wall Street analysts are positioned on Dollar Tree. It's completely fractured. You've got 8 analysts screaming buy, 7 screaming sell, and the biggest group, 10 of them, are just sitting on the fence with a hold. When the pros who get paid to figure this stuff out are this divided, it tells you that both the bull case and the bear case have very real, very legitimate points. There's no easy answer here, which is exactly why we have to dig even deeper. All right, speaking of digging deeper, I found this number from MarketBeat, and I need you to explain this to me. The trailing 12-month net margin is negative 15.40%. How can you sit here and talk about a solid foundation and pillars of profitability when the company is fundamentally massively unprofitable over the last year? This looks like a fatal crack in your entire argument. How is that possible? That is an excellent point. And honestly, it is the single biggest trap that's going to catch investors who aren't paying close attention to this stock right now. That negative 15% number, it's an accounting artifact. It's a ghost in the machine. That number includes all the losses, all the write-downs, all the cleanup costs tied to the discontinued operation, the Family Dollar business they sold. It has nothing to do with the health of the company as it exists today. We have to get back to reality. Like we said at the very beginning, you have to focus on continuing operations. The income from the actual ongoing Dollar Tree business for the fiscal year, it was a positive $1.2 billion. The core business is very profitable. That negative margin is just the noise from the demolition crew tearing down the old broken down building. It's not a flaw in the new one. So after putting the numbers through the stress test, after pitting the bull case against the bear, and after clearing out all that accounting noise, it is time for the verdict. We've looked at the new blueprint, we've checked for cracks, and we've put the whole structure under as much pressure as we can. So what is the final takeaway for you, the investor, looking at Dollar Tree today? Is this a huge opportunity to buy into a newly fortified company, or is it a value trap that's just disguised by some strong numbers from the past? Our iron verdict is this. Dollar Tree has successfully done the hard work internally. They have fortified their own corporate structure. By finally getting rid of Family Dollar, they fixed their single biggest internal weakness. The core business, the continuing operations, is showing strong profits, it's expanding its margins, and it's generating a ton of free cash flow. From an internal operational point of view, the foundation is much, much stronger than it was a year ago. They've built a better company. But that's only half the story. And that is the crucial question we're going to leave you with. Dollar Tree has rebuilt its house with much stronger materials. The design is sound, the balance sheet is clean, the focus is crystal clear. But they built that stronger house in a neighborhood that's sitting directly in the path of what looks like a Category 5 economic hurricane. The biggest risk to Dollar Tree is no longer internal, it's entirely external. The financial health of their core customer, the low-income consumer, is getting worse by the day. So the final decision has to be yours. Do you bet on the stronger house to be able to ride out the storm, or do you bet that the storm is just going to be too powerful for any house to survive without damage? That's the question you have to answer for your portfolio. Thanks for joining us at Iron Financial.
Quick disclaimer, everything I share is for entertainment and informational purposes only. I'm not a financial advisor, so please do your own research or talk to a professional before making any moves with your money.